looking for.
Absolutely. And I think what makes us most excited, Lisa, is actually your interest. For everyone joining us today, this topic of K-1s is one of our most registered and rewatched huddle topics of the year. And I see a couple of messages in the chat. This will be recorded, and we will send out that webinar recording. If you request it, just email us at invest@reepequity.com following today's huddle, and we will send you that webinar recording. But we're honored to share our knowledge, Lisa's experience with you on this 2024 tax season. And just a couple of quick facts. To date, REEP has actually delivered over 1,800 K-1s to our investors and partners in REEP deals. We have another 500 being delivered by the end of this week. And I just want to thank everyone on the REEP equity team, Lisa, our accounting team, everyone that puts in work to deliver these K-1s on time and early for our REEP investors. And of course, it wouldn't be possible without our CPA firm, Weaver. They've been partnering with us for several years now, and we are just so pleased, not only with their work, but just with having them as a great partner, a part of the REEP team. And again, before we dive into this topic of K-1s, we want to remind everyone that myself nor Lisa are not CPAs, financial advisors, or anything like that. And so today's topic should not be construed as tax advice nor financial advice. We recommend consulting with your CPA, as every tax situation will be different and of course could affect your personal tax situation in various ways. But let's go ahead and dive into some of these questions that investors have been asking about K-1s as they apply to multifamily investing here at REEP. And so this first question, Lisa, I'm going to ask you, what is that Schedule K-1? Why do I need one for my investment? And if I get a K-1, is it a requirement to file?
Sure. So the K-1 is basically your informational piece that is associated to your investment in the property or the investment. And you do need to get that to your accountant. That does need to be included on your return. And it's if you look at the form that the entity files, you are a pass-through investor. So that information then after it's filed at the entity level, it gets passed down through the owners or investors through the forms K-1, and then those are reported on the entity that is listed on the K-1. So it sounds like there's some individuals, there's some entities and some trusts and so forth. So each individual situation, and when I say individual, I mean each investor's situation is going to, depending upon what type of investor you are, it will be handled a little bit differently. So that's why it's really a good idea. Not saying you have to have a CPA or somebody assist you, but it's always a good idea because tax laws are constantly changing and you want to make sure you're taking advantage of every tax benefit that there is, and make sure that you're also reporting accurately as well.
Now, one thing you mentioned in that, Lisa, was the term pass-through. And this is a little off script, but I want to ask, because it's an important question, what things are passed through, I guess would be the correct verb, to partners of an entity or things like that?
Sure. So it's going to be what your share of the profit or loss is for that tax reporting year. If you have any distributions, there's also something called qualified business income deduction that can pass through. That is about 5 years now we've had that, or that has been eligible for individuals to use. when reporting on these pass-through entities. And then any other informational, there could be interest income that's also on there. Also, if there's any type of sale of assets that can be reported and to you through that pass-through K-1.
Very interesting stuff. And even within that last part, you've said several things I know of which we'll cover later on in this huddle. But speaking a little bit from the investor perspective, I invested in a deal. Now I have a K-1 and I've received it. I'm about to turn it into my CPA. But before I do, what are some things that I need to verify and make sure that are correct before turning it into the CPA?
Sure. First, you want to make sure that your name and your address is accurate. You also want to make sure that your tax identifying number is accurate. So if it's an entity, you want to make sure it matches the EIN that is for your entity. If you're an individual investor, you want to make sure that the Social Security number is accurate on that. Those, especially that first year of being an investor, you want to make sure that that information is accurate right from the get-go. And those are really, I would say, overall the pieces of information, no matter who you are or what type of investor you are, you want to make sure that that information is correct.
Very nice. Now, I think possibly, Lisa, I think this next question is actually from you.
This one here? Oh,
yes.
Okay. So when should REEP investors expect to receive their K-1s? They are due March 17th, because the 15th falls on a weekend. It's going to be the 17th. However, we with REEP and working with Weaver, our CPA firm, and Rebecca's team and my team in accounting, we anticipate to have, I believe, the majority, if not all, ready to go by Friday, the 14th. Yes.
That is correct. And so for all REEP entities, we will have those K-1s ready by this coming Friday, March 14th. That is if you haven't received it already. We mentioned earlier over 1,800 K-1s have been issued. And so if you haven't received yours, check your investor portal. And of course, if you have any questions, either accessing your K-1 or logging on to that new investor portal, always feel free to reach out to invest at REEP Equity, and we'll be glad to help. Now, Lisa, kind of talking more specifically on K-1s. We talked kind of the intro and how these K-1s work, but looking more specifically at these K-1s as it relates to multifamily investments, how are distributions, either monthly or quarterly, any type of distribution that I'm receiving from my multifamily investment, how is that reflected on the K-1?
Sure. So you're going to find in box 19 of your K-1, it'll be on the first page of your K-1. And box 19 will have, if there are distributions, there, and this is just relatively speaking, not per se for REEP, but whenever there's distributions, those are recorded in that box 19, and the amount that you had received and or with accrual based if it's been called, but perhaps maybe you don't get it till a month or two after, they're still going to be listed for that tax year. So again, that's box 19. Any distributions would be listed there.
And on those distributions that are in box 19, would I need to pay taxes? Again, not asking for financial advice or tax advice, because it's going to be different. Not only different in terms of the personal tax situation, but also I believe different year over year. But would I need to pay taxes on what is reported in that box 19, even if the property hasn't sold yet or anything like that?
The answer to that is in most cases, no. The only time that I've ever seen distributions, anything having to be paid tax on, is if for some reason the distribution of that current tax year drops the capital account below zero. And then that is considered a distribution that's over your capital account. And that is the only time in most cases. And again, as we've said, you obviously definitely want to consult with your tax person. But yes, in most cases, the answer is no, unless the capital account drops, that distribution drops the capital account to a negative balance.
And where could I find, you mentioned capital
Mhm.
account. Where's that reported on my K-1? Is there a certain section or a line?
Sure. That also should be on your first page of your K-1 packet. And sometimes they'll have that description further back in the packet as well. But your capital account is usually, and uh, um, I believe it might be box L, if I remember correctly, on your K-1, and that'll have your beginning capital account for the year. It's going to have whatever your profit or loss is for the entity, and it's going to have distributions on there. And also within your addition to capital, besides your profit and loss, if there's interest income and other various types of gains, perhaps that will also increase your capital account.
Very nice. And on a little bit of a related note, how would a sale affect my K-1? A property is sold in the tax year. How does that affect K-1s?
So when a property is sold, there could be various different things that you can see on there. You could see some capital gain. You'll see a change in your capital account, and sometimes there's depreciation recapture. Just depends on the assets, and then again, if there's a Section 1231 gain, which is again part of a sale as well. So in the year of a sale, you're probably going to see more activity on your K-1 than you typically do. It's very interesting that year of the sale. You'll probably have extra pages of details that go into the K-1 and the numbers that maybe you don't normally see in other years. And which is kind of, it's interesting to read. And definitely that is for certain, if you're trying to do your own tax return, when you sell, you definitely want to get some advice on that. That's my advice.
Absolutely. Yeah, I think if there's any advice that you can get from this huddle today, it's to get your CPA and find that team of
Mhm.
dedicated tax experts, financial professionals who really understand not only your tax situation, but also can, well, I think you mentioned this in the beginning, Lisa, really maximize those tax benefits, which we love, especially in multifamily investing.
Yes.
Now, I did see a question within the chat, and we certainly appreciate them. Please, to all of our investors joining us live today, please continue to drop those questions either in the chat or the Q&A box. But I think our next question is related to one of our the questions within the chat, and it is what happens if I invest in a property here in REEP, or here at REEP, we have all of our properties based in Texas, but I am located and I live in a state other than that which I invested in.
Sure. So, how that can work is, again, first you'll determine, there are a few other states other than Texas that does not have state tax, as far as reporting, tax returns. However, if you live in some states, and I actually am down here now, I've been down here for a few years, but came from Wisconsin. And one of the things that makes the state very different from federal is if your state is a non-conforming bonus depreciation state. And what that means, and many of you probably know, bonus depreciation is used to really maximize those first couple of years, 3 years of, being able to get some tax benefits. That's where some of the losses can help offset those older properties where, or I shouldn't say older, but properties that you've had for a while that are showing a profit. Those losses can, being passive, offset that. But when you live in a state, especially a state that does not conform to those bonus depreciation rules, you're going to have to add back that type of benefit that you receive on federal to the state. So again, a really important thing to do is to have somebody that you can go to and get that very specific advice to your specific situation.
Speaking of something new that I learned this week was actually that there are several states out there that do not, like you said, do not conform to the bonus depreciation laws or do not recognize that a part of the state's tax laws. It's another reason why I think, we're a little biased when we say it, but not only why we invest in Texas, but also why we live here too. It's a wonderful state for tax advantages, wonderful state for all the business incentives, everything of what makes Texas a great place. Now, we were talking about, unfortunately, the non-conforming bonus depreciation in those states, but how is that depreciation and other, call it non-cash deductions, accounted for in that K-1?
As far as non-cash deductions, are you talking about like profit and loss level?
Yes.
Yes. So when you have your income and your expenses, and we take out the bonus depreciation. Well, the bonus depreciation is also included, so that's going to get you to your profit or your loss. And again, going back to bonus depreciation, many times when you have that first year, especially, you are going to see a loss on your K-1 because that is such a great tax advantage, and so many take advantage of that, and that makes sense from that standpoint. But yes, so that is passed down on your K-1 through either a profit or a loss, depending upon that particular investment's situation for that year.
And can my K-1 lead to a passive loss that offsets potentially other income?
If you have other passive investments, you can offset that investment income. Again, passive income, you can offset that with other passive losses. And that's what makes the whole passive investment strategy so exciting, is because you really can invest in opportunities and be able to really strategize to really help yourself out when it comes to tax time. So yes, if all you have is W-2 income, then the answer is no. It's not, W-2 is not considered passive income. And then you would just carry that loss over to future years to be able to use at a later date, depending upon your individual situation. If you would eventually get another passive investment and that passive investment has income, then you can start to use those carryovers as well.
Now, you mentioned another term I absolutely love, carryovers, or that bonus depreciation that is carried forward year over year. And basically, from my understanding, until you can use it or until you elect to use it.
Correct.
Does it ever expire?
I don't, as far as a loss carryover, that I don't believe, but again, you want to talk to an advisor on that, but I don't believe that particular, when you have a capital account as an investor in a partnership, then no, there is no expiration on that.
Awesome. And one related question, can that bonus depreciation, and I'm tying some things together from what we mentioned, can that bonus depreciation offset possible distributions, sales proceeds, maybe even interest income when my capital account goes below zero? As
Uh,
long as there's a passive income or passive distributions?
Passive income, it really from a distribution in your capital, if you have a loss and you have other income, if that particular entity's capital account does go below zero, it's not, that does not coincide with other activities.
Okay.
So from the distribution standpoint, you would still, because that specific entity went below zero, then you would still fall under that distribution over capital.
Absolutely. Not, but you see how so many things within your K-1, not just that box 19 that has the distributions, but now section L, why that's important, having everything. And we're just talking kind of plain, simple K-1s. Call it, K-1 through cash investments, not necessarily IRA investments or other certain different vehicles that you can invest through. But I think we may have covered this earlier, Lisa, but I'm gonna just ask it again. Why does that K-1 show a loss on, I guess, within section L, even when I receive distributions, properties performing well, we received profit during that tax year, but why would it show that loss?
If you have taken more distributions than the what builds up your capital account, which means your in original investment and any income over the years, if your distributions would for any reason go beyond that and dip that capital account to a zero or below, you would fall below a zero. That does happen. It's not often, but it can happen. And some of the reasons is when you look at your K-1s, you're probably looking at it from a cash standpoint, where some of the things that especially bonus depreciation, when you make a purchase, you're not really spending outright that cash. So sometimes that can be confusing. It's typically within a new purchase, and it's just the way the depreciation is treated and different tax advantages that are out there. So it can make it a little confusing. And that's why you can sometimes see that happen.
Now, we talked, and I think we've hinted at it throughout today, retirement accounts and IRA investors. Does investing through a retirement account, whether it's a traditional IRA or a Roth IRA, tax deferred, does that impact the need for the K-1 in those if I'm investing through those retirement accounts?
Typically, and I say this again because you would definitely want to bring that to the attention of the person that you consult with for doing your taxes, but typically those are more just informational returns as far as being able to see what activity is going on within your retirement account. And then they also become useful for the sale, or for also if there's distributions at some point in time with that IRA account as well.
And one question that I've also received over the years is, if I invested through my IRA, who issues the K-1? Is it going to be the investment firm, REEP in the case, or of course, is it going to be my self-directed IRA custodian? And no matter what you invest in, it should always be the entity, of course, that you invested in, whether it's multifamily or any type of other asset out there. That entity, of course, will be the one to issue your IRA, even though it's going to be under that self-directed account name. We will be the ones to issue those K-1s. And I just looked at the chat, Lisa. We have gotten a lot of really good questions so far. So we appreciate everyone putting your questions in the chat box and in the Q&A. That's kind of the last of, I think, our discussion, but we're going to jump into those questions. So please continue to put those in there, and we will try our best to get them all answered. And I know we talked on this first question a little bit in the beginning of how K-1s work with state taxes. Of course, because K-1s, the tax returns are filed at that federal level. But the question is, do I need to file yearly to claim a loss in each state? Assuming that I live in a different state that I invested in. And is there a tax advantage to having losses prior to the sale of these properties?
So yes, you can definitely, if you, and again, going back to, and I use Wisconsin just because I lived there for quite some time, but depending upon the bonus depreciation and that not being conforming, the years after that, there's actually adjustments that for the year that you have that bonus depreciation, and let's say you have to add back X number of dollars to your state income because it does not recognize that bonus depreciation, then the years following, you will actually see a reversal of that to some extent. You're going to see more depreciation allowed at the state level than at the federal level. And so there's forms that are used to calculate that adjustment too. So yes, you definitely want to file yearly, just to make sure that everything that you're doing with the state, especially even leading up to that sale, that there's a tracking system, and you know that if whatever losses that there could be to take advantage of, that you've got a tracking system of that.
Very nice. And this next question I had, it was very good. So at the and we touched on a couple of these things, but there's a new term that I'm just, I guess, just learning or hearing of, because we talked about Schedule E, which is what I guess the K-1 flows through. Now talking about Schedule D. So when a property is sold, is there a different IRA form or anything else used to show that capital gain and loss for individuals who use their IRA to invest?
Sure. I don't have a lot of experience with the IRA accounts. I just have not seen a lot of them in my past experiences, but I do know that there are, just like the regular K-1s, there are certain entries that you can see on there that will exactly flow through to your Schedule D. And there'll be potentially some capital gains, there'll potentially be some capital losses. I would imagine, and this is from the distribution standpoint, those may be recorded as capital gain distributions at some point in time as well. But again, that's definitely something you're going to want to make sure that you are taking care of any of that appropriately. And that's why we really stress that you have somebody to go to make sure that you are reporting everything accurately and taking advantage of everything that you can take advantage of. So, and sometimes there could be, going back to the state, there could be something, and I'm using Wisconsin as my experience, but there's other states that have some benefits that that other states don't have. So you really want to make sure that you're getting the best possible advice for your personal situation.
And there was another question within that question that I saw, and I wanted to touch on because I think it's important to note not only when a property is sold, but also when a property is bought. So let's start in the beginning. Once a property, say the property is bought December 28th or even December 31st, I don't start receiving K-1s maybe until April, May, sometimes even later, just depending on the project. Do I still get a K-1 for that tax year, that when the property was bought?
If there is activity, yes, you definitely would, because you're going to have your opening capital account. And sometimes you may find K-1s in general can be literally just an informational type report. So even if there's no activity, you're going to want to have that K-1 because that's going to have your opening or your contributing capital, your beginning capital balance, the investment that you put into there. So and that's something that's very important is you want to make sure you're tracking your capital from day one so that you've got a good, strong handle on that. And so, yes, it's very important that even if it's for informational purposes, that you have that you get it to the appropriate person, or if you're somebody that has one investment and you're still trying to do it on your own, you really want to pay attention to that capital account.
And so that is on the acquisition side when a property is bought. Tell me more when a property is sold, because I think we even had a couple of dispositions within 2024, even within our own REEP portfolio. Some K-1s have the 2024 marked as the final K-1, others don't. So tell me more, what can cause that?
Sure. So sometimes there can be just outstanding items that just make it float over into the following year. It could be a recognition of some type of revenue from a tax basis versus a book basis. There can be potentially that distributions have not been finalized for the sale. There could be just different things that could be outstanding with that property that just were not able to, especially if it's toward the end of the year. It just makes it more common where it can carry over into that next year.
And I know on this next question, we answered it earlier, but I want to rephrase it a little bit. So that beginning capital account, it's always going to be my investment or invested amount. Say that was $100,000, just for example. Will that same $100,000 be shown on future years K-1s as maybe not certainly the beginning, but will it ever say that on my K-1, yes, this is the
your original?
Exactly.
No. So that's why it's really, again, going back to the tracking, it's going to change every year. So you're going to have that very first one's going to have your opening, if you will, your beginning capital amount. And then from there, it's going to have the profit and loss, any distributions, and then you're going to have a new capital amount. And that is the amount that will carry over to the next year. So it's always a good idea, especially if you're an Excel person and you like using Excel, tracking it yourself. It really is a good idea. Even if you have somebody that you are taking your taxes to, try to keep track of it yourself too. And then that way, if you're seeing on your tax return, the capital account that's pulling through there on your individual side, most of the time they will have actually a capital account tracker and you can compare it. And that way, if something doesn't look right, that gives you the opportunity to ask the questions. And sometimes there's a very valid reason that in your specific situation, and that gives you an opportunity to make sure that everyone's on the same page and that you're not missing anything. And then also it's kind of a learning tool. Some things that you may not think of can affect the capital account potentially.
Absolutely. And this next question is, does the K-1 show a current value? And I'm going to pause to say fair market value, which can be used by my IRA company to do a Roth conversion of the assets within my traditional IRA to a Roth IRA account. And a fair market value of these IRA investments, it is an annual, and I've even looked into the tax code. It's not even a requirement, but really quite a suggestion by the IRS to have within all of the IRA retirement accounts for these self-directed or alternative assets. So unfortunately, your K-1 does not show that fair market value. Even the fair market value that is reported to your IRA custodian each year from REEP, those actually are going to be a separate form we can do anytime during the year. But that brings up a really good point that I think may also be a future REEP huddle topic is those Roth conversions, really utilizing them to best maximize your tax situation, not only your investments, but also to really take advantage of the tax laws that are written and created for real estate investors
That's
out
super
there.
exciting to hear because Rebecca has a little bit more knowledge on that topic than I do. So it's just like this huddle. It's always exciting to learn something new and to have an understanding of those things. So that was great. Thank you.
Well, thank you. And of course, our fair market values, they're always, reported, I think, within January, which is a busy season for not only, much of the world, but also for all of our financials, preparing these K-1s, getting everything to our CPA and their team over.
Yes.
And there's our next question. Can we get examples of passive incomes that can be deducted by those passive losses on my K-1s? But I think another way, and how I'm going to ask you this, Lisa, is what is not considered passive income?
So what's not considered passive income is W-2s. That's a very basic standard that almost a lot of people do have. If you have like dividends from a mutual fund, that type of thing, that those losses cannot offset that. If you have direct, or what I should say, a majority share, and you are active within another type of entity, that is not considered passive. That those are three big things that sometimes that a lot of people do have. And so those, probably the biggest one that can get a little confusing is when you do have ownership in other types of entities. And not all of them are going to be passive. Sometimes they are non-passive, which means you have more of an active role in that, or a larger shareholder stake or partner percentage on that. So that is probably the biggest one that people get confused on, is know that there are entities out there that they're still pass through. Anytime you get a K-1, it technically is pass through income, but it's the type of pass through. Is it an active, or is it, a passive income or loss, or a non-passive income or loss? If you are active in that particular entity, and let's say you have a $10,000 income and you have a non-passive loss of $10,000, you cannot offset that non-passive with that passive income. So again, it's very confusing because they use passive very differently. I mean, they're all pass-through entities, which that's the key to remember, is when you have a K-1, it's a pass-through. When you're talking about your type of participation, or your type of entity, or your type of investment, that's when we use passive versus non-passive. So
very interesting. And anything else? I'm trying to think of all the different types of income, even thinking of my own tax forms. What else is passive? Anything else you can think of that would be considered? Because we talked on what is not passive income, but what would be, besides some of these distributions, and certainly K-1s, or the distributions from K-1s being passive. Anything else that may be considered that passive income?
I think there are, but I think when you're looking at your K-1s, you can only offset that. If you have a loss, you can only offset that with that type of income. You can't, you can have all different types of levels of income, whether it be passive or non-passive. And when you say that, you're talking about, like we said earlier, W-2s, interest income, dividends, those types of things. Those are, when it comes to using those passive losses, those are the types of things, those general types of income. And another way to explain it is, other than your K-1s, when you look at the things that go into your adjusted gross income, um, those are things that most of that, which is what a lot of people have on their tax returns, would not be eligible to use that non-passive loss on. It's usually, you try to think of it K-1 to K-1.
Absolutely.
Yes, yes.
Yes.
Mhm.
And we were talking about IRAs earlier. And this next question, of course, also related to investing through an IRA. There may be what's called unrelated business income tax or unrelated business taxable income, UBIT, UDFI, unrelated debt financed income, all types of acronyms, and similar to even a fair market value. That term, it's not always the best descriptive term for these types of terms or classifications. But can you explain, if I invest through my IRA, do I need to also pay this UBIT tax? And this will actually depend on if the property has debt financing on the asset, because of the guideline or the basis of this UDFI UBIT tax is looking at the entity. Does the assets within the entity have debt or have leverage on that asset? UBIT, again, is something that we think, everything, even investing in a Roth, can be sometimes labeled tax-free. And really, it's certainly and very advantageous in terms of the tax advantages. But whether you're investing in equities like the stock market, bonds, or even these multifamily investments, there's still going to be a little bit of tax implications that are just a part of the IRS code. Second part of that question, when you have invested or when you have multiple ones invested through IRAs, I'm assuming that would mean multiple multifamily investments or multiple investments through your IRA. That, of course, is again going to go back to looking at the asset itself. If the asset is a multifamily deal similar to what we have here at REEP, then more than likely there's going to be some type of debt on that property, which will then create that UBIT and the UDFI within the entity for IRA investors. And we want to get through the rest of these questions. So I'm going to read this one to you, Lisa. So I'm in the middle of creating a trust. Should I wait until the end of the year before changing my K-1 profile, addressing my personal addresses to the trust? Is it okay to do it even now, even though we're in the middle of tax season? And let me say this a little differently to you, Lisa. Is there any type of implication that may cause, whether I change my name or I change my address? What effect does that have on my K-1? And is there ever maybe a good time and a not so good time to do that?
Sure. So the only thing that would generate, if you do change the type of entity during the year, that I believe would actually create two K-1s. You would have a K-1 under if it was an individual, you would have a K-1 coming for that time period that it was as an individual, and then you would also get a K-1 for the time that it changed to, say, a trust. So that's definitely something you want to, consider and keep that in mind, because you want to make sure that you receive, if something like that does occur, you want to make sure that you receive both of your K-1s for that particular year. And then as far as just a name or an address, if the actual type of entity that you are hasn't changed, obviously you want to have the proper and the most up-to-date information to us, by year end, or the very first of that next year, so that we can get that appropriate information into our database and make sure that we, issue the K-1 to the correct address, or if there's a name change, various different reasons for name changes, but you're staying the same entity, just a name change. That, again, that's just more of an informational thing, but yes, you want to keep that as accurate and current as possible.
And you brought up a really good point within that answer. And that, of course, would be kind of on the topic of transferring. Say I have, and of course, a Roth conversion would be the same type of transfer, same type of paperwork needed. But say I invested personally in all of these syndications, and now I created an LLC that I still own. I'm still the beneficial owner of now, but I want to hold all of my investments underneath that entity. You can certainly do that, and it's permissible to transfer the investments under the titling. I say not the physical. If I invested 100,000, I certainly can't sell that security, but I can certainly request that what is on my K-1 and those annual tax documents to change. And so those transfers, just like in the question, opening a trust, if you wanted, of course, to change your investments from either your personal name or an entity that you hold to that trust, please reach out to, I'll say, either us or your general partner, and we'll be glad to discuss more and get that transfer recorded for you. Now, Lisa, I think this one's directed at you because I see Wisconsin.
Okay.
And the question is, why do I need to report the rental activity in Wisconsin, or maybe a state that I reside in, while my investment is in Texas? Or what type of state reporting do I need to do?
Sure. So you do want to check with your individual state. Sometimes there's a limit, or you have to meet a certain dollar amount before you have to report it. So you always, no matter what, even Wisconsin that I talk about, you're still going to want to always check and see what that particular amount is. What dollar amount can I make in another state before that needs to be reported? In most cases, again, from a Wisconsin standpoint, they want to see your income from other states, even if the activity, because if you are a resident, a full year resident of Wisconsin, or a full year resident of another state, you need to double check and see what their requirements are for any type of entities that you own outside of the state, because many states, from a tax standpoint, they want their money, for lack of maybe a better way of putting that. But you definitely want to make sure that you check with your state and what is required there. And from past experience, I know Wisconsin, they want you to report it. So absolutely, because if you're a full-time resident, they want that reported.
Now, we've talked a lot on K-1's, Schedule E, Schedule D, but this is a new one that I haven't heard in a while. What is the Schedule K-3 for?
So the K-3 is, I believe, that has to do with foreign reporting, as far as like your foreign assets, if you have any foreign income, investments, that type of thing. If that particular entity is required to have that K-3 filing to report that information. So.
And we were talking about tax laws, tax acts before we started today's huddle. And I remember from a couple of years ago, I can't remember if it was a new 2022 act or maybe 2023 requirement, but I think the IRS made the Schedule K-3 not required, but they made it a part of every single K-1. Even if there's no foreign income, it's going to be zeros all the way across, which can honestly be quite confusing. If
Mhm.
I get my K-1, I invested in Texas or anywhere within the United States, and now I have the Schedule K-3 that says foreign income.
Mhm.
Even when I got my personal K-1s that year, I remember being a little confused and shocked of why do I need this? But it was simply just a new requirement of the
Mhm.
IRS that year.
And that kind of circles back to what we've been talking about, Rebecca, is this is just another reason because there are some K-1 packets that you get that are almost like a book sometimes. And that's why it really, it really is important that you at least get guidance from somebody, really because there's things that are going to be in there that really that may look to you like, oh my goodness, I gotta do this or I gotta do that, and only to find out it's an informational thing that doesn't possibly flow through to your return. So that's why, it's especially as you become an investor, you really want to have somebody to help guide you and to make sure that you're taking advantage of things and that you're also, when I say taking advantage, but you're taking advantage of um, you know, uh, different tax strategies and that you're also being accurate in your reporting too. Because sometimes, and I've seen it in the past where things are missed and then comes a letter from the IRS and, why wasn't this reported? Because that information that is given to you is also reported to the IRS. So they do have the information that we report to you. And so, yeah, when you can get that advice, and I'm sure many of you do, but if there's somebody out there that's still kind of on the fence, it just is a good idea all the way around.
Absolutely.
Mhm.
And we've talked, of course, on that capital account. And this next question is, how is return of capital and return on capital presented within the capital account, both during the hold and on the reversion or on a disposition? Um, and if I am understanding this question, it, we I say we as the general partner will sometimes classify distributions, most times actually, will classify distributions from a multifamily deal as return of capital. And that's going to be within your investments partnership agreement. This is all outlined within the operating docs of the entity. Of course, the opposite would be return on capital. And so tell me a little more, how would that affect my capital account if the distributions I'm receiving are return of, and they keep decreasing that capital balance?
Sure. Um, again, it can vary from, and you talked about partner agreements, those things are a very important part of that as well. But if you are getting a return of capital, you're still, that capital account is dropping. So that is going down. So from an actual year to year basis type thing, and whether you can use those losses, that is still, in a consideration in determining, if you do have a situation that can make that distribution taxable. Um, as far as like that final year, that becomes a whole different game, if you will, because you're going to have different factors that can, make sure that you do get that return of capital and that that capital account gets tied out and that capital account is basically zeroed out when you're done as well. And that's in the year of the sale.
And in talking on the capital account, the section L, if I'm not mistaken.
Yeah, and I apologize if it's not L. I don't have it. It's been a couple years since I've very intently looked at a K-1. So I could be wrong on L, but it's right in that area. So yes.
Absolutely. And kind of on that same, I say the left side of the K-1, same type of section or
Mhm.
just right above it, there's a couple of or a table that shows qualified non-recourse financing.
Mhm.
And how does that affect the basis for purposes of deducting losses, provided that there are sources or other sources of passive income like depreciation, bonus depreciation to offset that loss?
Sure, sure. So recourse, in my understanding, recourse is when you are personally liable for debts of the entity. You can, and that is one of the reasons why there were years ago that people were pushing everyone sign up as a S corp or change their tax classification to S corps. Was bonus depreciation really started coming into play, that it's more back to the partnership, because from a partnership, if you have recourse loans, again, that you are personally responsible for, you can use that, what your share of that loan is, to help build. And I don't want to say build your capital account like you actually get the money, but it comes into factor in calculation when determining how much of a loss that you can claim. So for that year.
And here at REEP, all of our debts or all of our loans on the properties, they are considered that non-recourse for the guarantors of the loan. Does that have any effect or any difference on the non-recourse loan versus a recourse loan as it relates to what's in the K-1?
It is on the K-1, but from my knowledge, it does not affect it, because you are not personally responsible for that. That is not going to be able to be used the same way that recourse loan is going to be.
Absolutely. And it looks like the last question I have, or that we can see within the chat, going back to income losses, and is the ordinary income and loss included in the rental loss, income and loss line on the K-1?
The type, for our specific situation, the type of business that we are, that is, because it is multifamily, that is where you're going to see the profit or loss for the operations of the entity. If there's interest income, you're going to see that on the interest line. But yes, not many K-1s, you'll see an entry in box 1. I believe ours is box 2 for the rental. So that's where you will see the actual activity, whether resulting in profit or resulting in loss for the investment, will be in that box 2.
Well, I don't see any other questions either within the chat or the Q&A box. Lisa, I just want to thank you. You have been a wealth of knowledge today. I have to admit, Lisa has no notes in front of her, while I have pages and have taken pages of notes during this informative REEP huddle that we hosted today. And I just thank you so much again. Thank you to everyone joining us live. But before we let everyone go, we want to remind everyone that happening just next week is actually our next educational webinar with none other than Jacob and Arlene Garza. They'll be joined by special guest Nate Hare of Directed IRA as they discuss the truth about using those retirement accounts. We've talked on it a lot today, but really, how can I do that? If I have a retirement account or I have a 401k, how can I utilize that to invest in multifamily and other assets beyond the traditional stocks, bonds, everything that mutual funds that typically is within those retirement accounts. We hope you'll join us for this informative webinar titled Busting Myths and Building Wealth. You can register it for this upcoming webinar within the chat. We'll be posting that link here very shortly, but also stay tuned to your emails, and we will send out everything you need to know on that upcoming webinar here shortly as well. And lastly, we want to also invite you to our next monthly REEP huddle happening on Wednesday, April 9th for yet another fun topic related a little bit to K-1s. going to be on cost segregation, specifically in multifamily investments. So watch your emails for that registration. We hope to see you there. And certainly we will send out everything as it relates to the registration of both of these upcoming webinars and events to you via email. Thank you again to Lisa, everyone joining us today. Have a great rest of
Thank
your
you.
afternoon.
Have a great day.